We have a special speaker today, Payal Shah, Director of Equity and Cryptocurrency Products at CME Group. And this is actually a topic, crypto derivatives, that we haven't covered in previous years at the Crypto Valley Conference. So I'm very excited that her masterclass is taking place today. And I know that she will do a fantastic job sharing her experience and her insights with us today. Payal, the floor is yours.
Thank you so much. Hello. Well, last session before lunch, so I will keep this short, keep this brief. I know everyone's eager to get out there and get some sun. So yeah, tough gig, hey? My name is Payal Shah from CME Group. I'm based in London. And first of all, it's so nice to see so many familiar faces and new faces out there. Really looking forward to 2 days of excellent conference, the boat party for sure, and looking forward to meet all of you as well. So very quick intro. I lead equity and crypto products at CME, and what that entails is creating new and innovative products on our key benchmarks. So that includes everything from S&P, NASDAQ, Dow, Russell, and on crypto products as well. So we define that as Bitcoin and Ether. I've been at CME for about 7 years, and probably that's as long as CME has been in the digital space as well, so very exciting times. So we have recently celebrated the 5-year anniversary of CME Bitcoin futures, and I thought I'd share a few observations from our journey. So there'll be a test on this later. So the evolution of crypto products. We began in November 2016. Really, that was our starting point. And we introduced with crypto facilities, benchmark providers in the space, our Bitcoin reference rate in 2016. And this was really to give participants a credible reference rate, which we call the Bitcoin reference rate or Bitcoin real-time index. And a year later, given the real upwelling of demand that we were seeing from clients, we then launched our Bitcoin futures product. And that product is a 5-time futures multiplier. So one contract is 5 Bitcoin. And that's really grown, since we launched it, it's now grown tenfold. We're now seeing about $4.5 billion notional, $1 billion traded every day. So, real growth in that product. As a natural extension, we then launched Bitcoin options in 2020, and really that was a tool for participants to both hedge and manage their risk. And we're seeing interest come from a whole range of market participants. So everyone from banks, hedge funds, asset managers, allocating to that new digital asset space. Also, what's interesting is the rise of new participants or new industries. So the rise of crypto nascent companies that are trying to bridge the gap between both the traditional world and the new asset class. And what's also growing, which is quite important as well, is the evolution of this ecosystem. So we're now seeing OTC markets, we're seeing ETFs, we're seeing a real melting pot of all of these different access points coming together. So the approval of ETFs actually on crypto or on futures-based Bitcoin was a real milestone for us, and it was validation of something that we knew for a long time, that the CME futures product was a real, showed price transparency in the space. And so going forward, we then launched Ether futures, and that was, as we saw the rise of Ether really coming through the acceleration of DeFi products, through NFTs, through stable coins, and an interest from traders as well. And so we launched Ether futures in 2021. Now that product is a 50 times multiplier, so 50 Ether is one Ether futures contract. And a real expansion from both Bitcoin to Ether really cemented our position within the crypto markets. Now, rising prices in 2022 meant that the Bitcoin futures contract maybe got a little bit too big and started pricing some people out of the market. So we then created the micro futures contract. And this was at the time when COVID had hit, there was a lot of active retail traders in the market as well. So those micro products are 1/10 of a Bitcoin or an Ether. So for Ether, we're talking about a really small contract, so $200 notional. And what we're actually finding is both institutional and retail participants in that product. So with retail, it's people trying to dip their toes in, trying to learn the markets, access the markets. With the institutions, it's more around fine-tuning their position. So an ETF provider, for example, might use both the standard future and the micro product as they're trying to fine-tune their exposure. And into 2023, we've already been really busy. We have launched a couple of new trading mechanisms. We've increased our reference rates. And last week, we also introduced weekly options on both Bitcoin and Ether. So that's a weekly options contract. So you have a new offering, a new expiry every day of the week, so Monday through Friday. And that really, given the volatility, something that traders were really asking for. So, what have we been seeing recently? 2022 highlighted a lot of structural issues in the marketplace. There was Terra Luna, there was the collapse of UST, Three Arrows Capital, Voyager, Celsius Bank, BlockFi. I mean, the list goes on. But all of those things, all of those failures, unfortunately, highlighted a lack of risk management. And if we go into 2023 as well, high interest rates, high inflation has meant companies like Silicon Valley Bank, Silvergate, Signature, all of those have been wiped out because of that capital reserves that they no longer had. So those turbulences that we've seen in the wider market, that actually increased the understanding of CME products. And that's really for three reasons. Firstly, ease of access. Secondly, counterparty risk, or how we, using a centrally cleared product and mechanism, that counterparty risk is mitigated. And thirdly, consistent liquidity in our markets. Just grab a little drink over here as well. So as I put this chart up, time and time again, when we've seen volatility in the underlying crypto markets, investors have come to the CME platform to manage that risk. We remember last year in November, I wish I could touch all the way up there. We remember last November, following FTX, that was the single one largest trading day for us, where we traded over 210,000 contracts in Bitcoin. And again, Silicon Valley Bank, and in the days in March of this year, we traded $4.6 billion notional. So time and time again, when we see volatility in the underlying crypto markets, we see some of that trade coming to CME. So coincidentally, actually, right now, we're seeing volatility at 2-year lows. Obviously, after FTX, volatility was high. It then came down through the end of the year, and the volatility number is around about 40% right now. So through that, we're seeing actually a lot of options traders come into our market to take advantage of that optionality. And again, we see, when we pair that with our traditional markets, we see crypto markets echoing traditional markets. So people want to participate because of these events. They want to participate because of volatility, and they want to use futures to hedge or to speculate. So the events of last year and the price rally of this year, certain themes have certainly been highlighted. So one, we've seen an increase in account openings. So really people turning to our markets, not just to CME, but across the space to manage crypto risk, whether that's a regulated platform like CME, the OTC platforms, the unregulated, and we're starting to see that interrelatedness across all of those platforms. Now, being a regulated venue, a trusted venue, and offering that centralized clearing where we guarantee the trade for all market participants is some of those facets that we see in our other markets that now people are starting to really understand with crypto. And they're starting to refocus in on why it matters so much. So CME has, we spoke about our 7-year time frame in crypto. I want to take you all the way back. So CME has a very long history of innovation. We started off as a butter and eggs exchange about 200 years ago on the streets of Chicago. And since then, we've constantly innovated. We created the first futures on corn way back, and then FX futures in the 1970s. So we are the largest, most diverse futures exchange. We cover all 6 asset classes, so that's FX, equities, fixed income, metals, ags, and of course crypto, which everyone loves here today. And we're starting to see the interrelatedness of some of those markets. We are the venue, obviously, for risk management and for nurturing the innovations that we're seeing in all of those asset classes. And really with crypto, it's exciting to see how we've pushed that frontier of finance, and it's the melting pot between technology advancements and applying some of the lessons that we learned with our traditional asset classes. So what does 180 years of innovation and 180 years of history tell us? Well, one, it shows us the importance of a marketplace with deep liquidity. 2, it shows us we are the natural home for crypto trading. And that's because of our time-tested markets. It's a place where obviously buyers and sellers can come, where hedgers and speculators can come. Earlier we heard about the need for insurance on your crypto assets. Well, this is another kind of risk that needs managing. So let's skip over to here. So what we offer is a regulated, centrally cleared, cash-settled crypto futures product. So let's take each one of those in turn. So crypto futures, pretty self-explanatory, right? So a futures contract, agreement to buy and sell a futures product at a point in time. But the interesting thing is that you don't pay the margin up. You don't pay the price of that contract up in full at the beginning. We just take a margin. And so when we launched crypto futures or Bitcoin futures back in 2017, that margin that we were charging for creating the futures product was around about 40%. With the reduction in volatility over the past few years, we've now reduced that down to about 28%. So to access a futures product, that 5 times Bitcoin contract, we're looking at about 28% margin on one contract. So regulated by the CFTC. Obviously, we're headquartered out of Chicago, so we are regulated by the CFTC. And what that means is the assets that you have with us are regulated in exactly the same way as with any of our other contracts. So we treat crypto in exactly the same way as we do S&P futures, WTI futures. It's the same regulator and the same checks and balances on any futures product as with crypto. Now, by being regulated also by the CFTC, it means that our products can be global in nature. So what we find is trading comes predominantly from the US markets, but about 45 to 50% is actually outside of the US. So 45% of trading happens before the start of US markets. Trades come in from about 130 different countries, And even through the recent banking crisis, we've seen that people throughout, from especially Switzerland, from Dubai, a lot of European companies are looking at that regulated stance that we offer. So moving forward also, the concept of segregated funds, I think, will be pretty important as well. With CME, because we're regulated, all the funds are segregated both at a clearinghouse level and at a customer account level. And so through the CME clearing offering, CME becomes the buyer to every seller and the seller to every buyer. And therefore, we guarantee every single trade, the clearing and the settlement of every single trade on our exchange. What's interesting is also we have futures and options, but we're also looking at expanding beyond that offering. So how can we work with banks to offer NDF products? So we have a tradable NDF product coming on the pipeline. We also have a cleared solution. With our 180 years of experience, we also have developed checks and balances. So, things like dynamic circuit breakers that prevent the market overheating. And so if the price rallies too quickly or the market moves too fast, those circuit breakers kick in to slow that market down. We also have position limits in place, so that prevents any overconcentration. So any one participant can't own too much of that market. And that acts as another check and balance that we have across all markets. We also have a no auto-liquidate function. So you may have seen on some of the other exchanges, auto-liquidate, clawbacks, and that risk really is taken away with the CME offering. So the margins are set in line with volatility. There's all of these checks and balances that take place. So really, comfort in trading and that ease of trading is what you get with the CME product. Now, it's cash settled. So cash settled USD contract. And through that, the barriers of entry are reduced. So if you think of a cash settle, you get exposure through an index that we created, as I mentioned, with CF benchmarks. But you don't need to handle any of the complexities that come with that. So you don't need to handle things like wallets. You don't need to deal with insurance. You don't have to deal with hackings. And really, it does away with some of those barriers of spot. And so the ease of access is really key. With futures also, the ability to short as well as go long. So we saw a lot of shorting activity over the course of last year. And then price discovery. So with a cash settle contract, obviously, with other markets, we see price discovery on futures leading spot. So if you look at our equity contracts, the amount that's traded on futures is probably 1.5 to 2 times more on futures. And if you compare that to ETFs, it's probably 10 to 12 times more on futures. So really, as with a cash settled product, the ability for price discovery is there. And on some days, we're trading more on CME futures than the sum of the top 5 exchanges out there. Now, the rate, let's go here, the CME CF Bitcoin rate. So the rate pulls in Bitcoin to USD transactions from 6 of the main constituent exchanges that we've identified. So just talking about the rate a little bit more, it's a 4 p.m., the CME CF Bitcoin rate, or the BRR, as we like to call it, settles at 4 p.m. every day. And as I mentioned, it pulls in the spots, so the transacted trades, the executed trades at 6 exchanges. And those exchanges are Bitstamp, Coinbase, Gemini, Itbit, Kraken, and LMAX. And through those 6 exchanges, about 70% of global Bitcoin to US dollar transactions is captured into that rate. Now, you may have seen some other rates have more exchanges. Some have less. Obviously, there's about, 200 or 300 venues that you can trade spot. We've selected those 6 exchanges because they meet the very strict entry criteria that we as CME and our partners at CF have defined. And that means things like looking at market manipulation, ensuring that those exchanges have strict rules and procedures to prevent that, or to spot that, or to do something about it in the event that it happens. They also have exchange information sharing agreements with CME. So all the things that make the underlying index as robust as possible. So as I say, some have more, some have less. We've stuck to 6 for now. And so, as I mentioned, it's the executed trades that happen on those 6 exchanges between a 1-hour window that we call the calculation hour, or the observation window. And that window for the majority of our reference rates, or in fact all of our reference rates, is between 3 and 4 p.m. London time. And so how we calculate the rate is, I guess, part of the secret sauce. So that 1-hour calculation window is partitioned into 12 5-minute samples. And for each sample, the weighted average median price is then calculated. So then of those 12 samples, we then take the straight line average to give the daily BRR price. And I guess we really did our homework with the reference rates. And part of that design mechanism was what made launching futures contracts so easy. The methodology was transparent, it's observable, it's discrete, it has an oversight committee around it, so making sure that the reference rate is fit for purpose. Everything as you would see with any other index on S&P, on WTI, and the key thing with CF benchmarks is that it's BMR approved, and it was actually one of the first crypto indices that was regulated by the FCA. What's most important for us from a futures perspective is that even at times of high volatility, it's shown to be reliable. So since launching it in 2016, there has never been a day when the rate hasn't been published. There is obviously republication methodology. It hasn't needed to be used. And the reason for that is if we dig a little deeper, the way that the methodology was created with the use of medians, that reduces the effect of any outlier prices. The reason that it's volume weighted filters out any small or multiple small trades that would otherwise move the price. Trading across multiple exchanges, if anyone wanted to move the price or manipulate the price, they would need to trade on multiple exchanges on all of the partitions to move that price, because it's 12 5-minute segments, so you need to be there in all partitions. And most importantly, there's no over-reliance on any one exchange. So as the BRR is used in futures calculation, in NAVs, in ETFs, and so many more things, during the design process, we saw the impact of some trading frictions, and so differing KYC or AML practices on some of the exchanges led to a differing price. And so during that design process with the BRR, we only use Bitcoin to US dollar trades. We don't apply an FX, we don't use a conversion rate, and we don't use USDT. The other thing that's really key, and again, I keep taking this back to S&P or to WTI. So, the WTI benchmark, for example, has been in operation for about 40 years. So we're taking lessons from the asset classes that we know well, and that have suffered from huge downturns in markets as well. So taking lessons from those asset classes, the idea of converting to an index or convergence to an index is pretty key as well. So in the same way, the S&P futures converts to the S&P index, our Bitcoin futures contract converts to the underlying index. So the BRR is published every day, 24 7 days a week, 365 days a year. The futures contract settles monthly to that reference rate. And when it settles, so on the last Friday of every contract month, we see convergence between the index and the futures price. And that's really powerful because it keeps both the spot markets and the futures market related. So we've covered a few of these things, right? So oversight committee, built with controls. The other thing that I wanted to highlight, and I spoke about before, was the choice of observation window. So if we look at, I think this is going back a couple of years, but it's something that CF Benchmarks updates periodically. And when we look at the transactions across all of the spot platforms, we want to pick the hour that is most representative of the trading that we see. So if we look at the volume of trading, we chose the 3 to 4 hour because it was the largest hour that we saw a lot of those trades go through, so 3 to 4 p.m. London time. Now, how well correlated are constituent exchange prices? So when we looked at the price-wise correlation of prices from different constituent exchanges on a minute-by-minute basis, i.e. the price difference between transactions on each exchange, so Bitcoin versus Coinbase or Kraken versus Itbit, during that observation window, we obviously saw a correlation at 1. Now, on 1% of those days, the correlation was below 0.5. A little broken during the FTX collapse last year, but what this shows is how closely correlated the exchange prices are. And there's no over-reliance on any one exchange. So sometimes with other indices, they may be affected by a flash crash or one constituent exchange going down. If any of those 6 exchanges went down, the BRR would not be affected by that flash crash or outages that we may have seen on Coinbase or Kraken at different times of the year, whether they were suffering from hackings or from anything going on in that exchange. So reliance on that, the publication is key. So overall, we now have 50 reference rates and real-time indices. So the real-time index, I've spoken a lot about the BRR as a once-a-day price on Bitcoin. We also have the same once-a-day price on Ether, the Ether dollar reference rate, and all of these tokens, as well as a real-time index. And the real-time index, as it states on the tin, is a ticking every second of every day, so 365 days a year, and that price is to give a real-time cut of what the underlying token is. So 50 reference rates are, on at least 22 tokens, and those 22 tokens represent about 95% of the investable asset class. They cover the top tokens in crypto. We've also looked at sectors, so the metaverse or DeFi. Now, not every rate is going to, unfortunately, grow up to have a future on it. Some of them are too small. But the thing that we want to try and highlight is that some of the things that we're trying to address is whether are there contractual arrangements, are there loan arrangements in these projects, and we're trying to bring transparency on those projects with a once-a-day and real-time fixing on them. So, in terms of who might trade, I'm obviously not going to go through all of these things, but if we look at the personalities that we see in the crypto market, we see very similar personalities in our other markets as well. So with Bitcoin and Ether futures, both of those have a 2-year term. So taking Bitcoin futures, we have contracts that go out for the 2 years. And that establishment of a 2-year term structure is really important. So if you think about miners, for example, they can use the forward curve to see how much they should be spending on CapEx, or how much they should be mining right now, or how much they should be investing for future growth and development. And it's that forward curve, much in the same way as we see in gas or in electricity, that's helping those miners or helping those people with balance sheets in crypto make those forward calculations. So as I mentioned, we just passed the 5-year anniversary of Bitcoin. When we launched, we were doing about 1,000 contracts a day. We're now doing about 10,000 a day. Ether that we launched, the uptake on that was a lot quicker because a lot of the contracts, firstly, they're plug and play, so they fit into the ecosystem in the way that any other contracts would do. But the familiarity with crypto had already grown by the time that we launched Ether. So the take-up on Ether was a lot quicker. The bigger size contracts, the standard contracts, are attractive to institutions, to ETFs, and the smaller ones line up with what we see on some of the other platforms and on the overseas platforms as well. What's also nice to see is the evolution of spreading. So between the two contracts, we see Bitcoin versus Ether trades, and they enjoy risk offset. So if you were to long one, short the other contract, you would enjoy the risk offsets that brings. Another thing that we're working on, which we should be launching at some point over the summer, is an implied Ether to Bitcoin contracts. So the ability to do all of that spreading within one contract. And as I mentioned, the appeal is global. So 40% is coming outside of US markets. Europe is probably making it about 30% of the trading that we're seeing. We were the first exchange to offer both crypto futures in both USD and euro denominated. And so our euro denominated Bitcoin and Ether futures contracts work the same way as our standard contracts. The only difference being that the reference rate is a pure Bitcoin to euro denominated rate, and the same for Ether. So in Europe, really, we're seeing a few things really come through. We're seeing more clarity from the regulators. We're seeing more access points in Europe. So the emergence of ETFs, ETPs, funds, and we're seeing because of the fragmented nature of the EU, people embracing technology quicker. So we're really seeing a growth coming from Europe, and that's growing. So we were seeing 30%, it's now up to about 40% or so. And that's reflected by large open interest holders. Now, large open interest holder stat is an excellent measure of participation. So the large open interest holders has grown to over 400 contracts over the entire suite. And if we look at Bitcoin alone, large open interest holders is around the 114 mark. And for context, it's a stat that's put out by the CFTC, and it shows any holding or any holder of Bitcoin of more than 25 Bitcoin contracts. So if you look at the standard Bitcoin contract, obviously that's a 5 times multiplier, so that's 25 times 5. So any holder holding at least 125 contracts, and as I mentioned, we have 114 or so large holders, and they probably hold about 1.2 to 1.4 million. So pretty sizable growth there. New options also has led to that increase. So with the volatility, we also saw a demand for options. So with up until very recently, we had the options line up with our futures. So on a monthly basis, the options would settle to the future. We now have that weekly offering as well, and that's contributed to some of the growth that we see. So in the final moments, I want to share some crazy slides. We're obviously price agnostic, but some of the things that we're watching as we go into 2023, and I hope that will give you some ideas of how you can use futures. So the key themes that we're seeing across, from client conversations and from what we see in our markets is firstly a Fed pivot and an economic slowdown, which I won't go into. Everyone's well versed on that. Regulatory clarity coming from the CFTC and the SEC. Third, the Bitcoin halving and other ETH upgrades that are on the pipeline. Fourthly, tech developments, the emerging use cases from NFTs, DeFi, Web3, and that requires purchasing Bitcoin rather than, Ether rather than Bitcoin. And so, we're hoping that the spread contract will really tie in with that. And then really client appetite with a very risk-on approach. And so whether clients are using that as a hedge against inflation, whether they're looking at futures as a tech play, and really getting very comfortable with the volatility that the crypto space brings. So these crazy charts. Firstly, miners' revenue per transaction and Bitcoin price. So I thought this was a super useful and really fun chart to set the scene. So this chart is a phenomenal indicator of when Bitcoin crashes and when it rallies. So the Bitcoin miner's revenue per transaction is basically how much a miner will charge for the privilege of matching trades on the Bitcoin blockchain. So normally it's pretty low, but it spiked in 2021 when Bitcoin fell to 93%. It then fell again in 2014 where Bitcoin fell about 83%. Similar pattern in 2018 when Bitcoin fell to about 82%. And similarly in the latest bear market where Bitcoin fell about 70%. And so the other thing to know about this chart is after the spikes, when the cost of transacting is low, is when the Bitcoin rallies have happened. And so the biggest rallies occur, obviously, after a lull of trading. And so, a really compelling chart, I feel. The spikes, Bitcoin spiking before the crashes, and then rallying to lower levels. So some more crazy ones for you. So when we talk about spikes in transaction costs being related to the halvening. So the halvening obviously spikes the costs as the halvening happens every 4 years. In the first 4 years, there were about 2.5 million coins created each year. And then it dropped in half, and in half, and in half, and I'm pretty much running out of space as the lines have got so small. But the hard limit, as we know, is 21 million coins, which will reach in 2140. And we're getting pretty close. So we're already at about 19 million coins in existence. So every time a halvening happens, it spikes the transaction cost. So going into the halvening next year, we're seeing a huge rally in the run-up to that. And then as Bitcoin becomes a little scarce after the halvening, it becomes super expensive to transact, and then it crashes. And this really ties in with what we're seeing in the market and what we saw in the last halvening. What we might get is a nice bull run, and then maybe another crash after that as miner revenues reduce per transaction. But it's hard to say if Bitcoin will get to new record highs because the number of users has peaked. So this is an interesting one. So this is the miner's revenue, the miner's revenue per transaction divided by price. And it's showing the number of transactions per day. And it's obviously grown from 1,000 to 10,000, 100,000 to 300,000 at the beginning, and very correlated with the exponential growth in price. Now, a problem that BTC encountered since 2017 was that there's been no further growth in the number of people using it. And so the price is going sideways, as we've seen of late, rather than upwards. Now, from a technological perspective, people have been unable to expand their use case, partly because of the halving and the fixed supply. But what we're seeing from a financial markets side is quite the opposite. So we're seeing an expansion of use cases. We're seeing all those different access points come to the market. So futures, OTC, ETFs, funds. And that's what's driving the price. So, when we look back, people using futures, for example, to position for the Coinbase IPO 2 years back, or when Bitcoin went from about 30,000 to 65,000, and then the launch of the first ETF based on futures contracts. So those applications, we feel, that's what was missing to really drive forward the economy. And we've started to see the growth of that from a financial perspective, and really access points, through futures, allowing asset managers, pension funds, those pots of large money entering the space. Another interesting thing is the difficulty or the hash rate. And so this is the number of calculations required to produce a Bitcoin. And obviously it went from 10 to 100 to about 10, 1 to the power 13, so 13 trillion calculations. And again, relates to the various problems of Bitcoin, that it's expensive energetically to mine. But when we overlay that with some of what we're seeing, in the broader CME world, some of our energy market participants who are using repurposed energy, so flared gas, hydro, wind, they're seeing that real benefit from the intercorrelatedness or the interdependence of our markets. So although Bitcoin mining difficulty price is where it is, we're seeing the application of how different market participants are using both energy and Bitcoin contracts in tandem. Finally, so one of the main, or the biggest narrative that we see is a correlation between S&P, Nasdaq, and gold. And so in the early years, from about 2012 to 2020, there was basically no correlation, i.e. zero correlation. And since the beginning of the pandemic, recent correlation between S&P, gold, and Bitcoin, S&P, and Nasdaq has been around about 0.6% on a 1-year rolling basis, and that peaked out last year. And really, what drove that correlation was the tech bear market, where Nasdaq and S&P came off. So obviously S&P tech heavy, but not as tech heavy as the Nasdaq. But what we saw was all three markets very correlated. So they would fall on the same day, they would fall in tandem, and then they would rebound in the same day. And then as sanctions in Russia have also begun to bite, we're seeing a correlation between Nasdaq, S&P, and Bitcoin as well. And those three, as those sanctions have begun to bite, that correlation has weakened in the past few months, but has actually strengthened towards gold. And so in other markets, we saw the Russian central bank buying gold and increasing their allocation to Bitcoin. So It's interesting to see, the long-standing narrative between the three asset classes. What's certain is that Bitcoin is starting to get correlated with S&P and Nasdaq, and in times it's correlated to gold. Right now, probably about 0.5, so not really that strong. The one thing that we are seeing is the the cyclical nature of this. So when we look at with equity contracts, as we look at sectors, we're seeing people rotate out of S&P and into Bitcoin. The same with Nasdaq and kind of vice versa. An interesting fact is actually a lot of the younger traders in gold are actually doing a switch between gold and crypto. So that's quite interesting to watch. Now, the last thing that we're seeing is, when we look at gold, and something that makes that pretty interesting is that every year we mine an additional 90 to 100 million ounces of gold, but that only increases the supply by about 1%. So the gold supply grows, but grows very, very slowly. And that's why people have always seen gold as a store of value, and that's shown by the drawdowns there. Now, if you look at the drawdowns between Bitcoin and gold, gold has seen as much as a 70% drawdown, but very, very slow in comparison to Bitcoin. And in the last decade, the drawdowns have only been about 40%, even with the recent all-time highs, whereas Bitcoin has had multiple 80 and 90% drawdowns, much above 75% in the last 4 or 5 years, so a very short time. And so just to explain this chart, if it's at 0%, that's a record high, and anything below that is a drawdown. So, even through the recent rally of gold, the drawdowns were pretty stable. But Bitcoin, huge drawdowns. And then the last chart, I think, is, when we look at the rise of Bitcoin and gold, and we spoke about this earlier, the measure of the 1-year rolling standard deviation of returns in gold has a risk level of about 20%. And so realized volatility for gold is about 20%, whereas for Bitcoin, it's anything above 60%, so often closer to 80 or 100%. But in recent years, that volatility really has come down, and we're talking about a volatility number of about 40%. So although 4 times more volatile than gold, people are getting more used to the volatility and allocating to that. So I won't. And so this is a crazy one. This is what inflation would have been like if Bitcoin were a currency. So there would have been times where we see negative 100% inflation. So we'll skip over that one. Anyway, so now with the Fed's actions a little bit more predictable, and looking at the graph, up until about 2020, we saw the correlation between, obviously, Nasdaq, S&P, and Bitcoin was negative. And the moment that it flipped and never looked back was, about 2022. And what happened at that moment? Well, it was the point where the Fed created about $3 trillion in about 3 months with quantitative easing. And the correlation strengthened further last year when the Fed started reversing that. And so it's the same picture that we see in equities as well. And so the Fed has been lowering the value of the dollar versus fixed assets, and then raising them back up again. And so the effect that has, as I mentioned, on Bitcoin is very similar to what we see in equities and gold. Neither of them like it when the Fed raises rates, and the chart shows the effect of monetary policy on Bitcoin. So, whatever your view on the Fed, on regulation, on whether you think that crypto is a tech play, what we're seeing is the shift in conversation. So when we were speaking to our clients about 4 or 5 years ago, it was really, what is crypto? What is Bitcoin? And now that conversation has changed to how do we get invested? How do we join these markets? And the things that we certainly point out is that time-tested, regulated, liquid markets that we see. So as you guys develop other products, we've been very busy from our side. We bought in 2022. We bought a new product to market every month over last year, so that's 12 new products, and we're continuing that cadence this year as well. So as you kind of grow in the space, and please feel free to grab me at lunch or at drinks, and we can find ways that we can create products that are useful. Thank you.